My name is Andrew Stotz of the Valuation Master Class, and I want to welcome you here. We're going to have another student presentation, and this time it's going to be the company named Mazda. You know anything about Mazda? I never looked at Mazda, so I'm really interested in what's going to be coming from our student who's getting ready to graduate after spending many, many hundreds of hours learning about valuation. If you want to build a competitive advantage in company valuation, then join us here at the Valuation Masterclass. Let me invite our student in. George, how are you?
I'm doing well. I'm doing well, Andrew. Hopefully, same goes for you.
I am great. In fact, I just got my new bookcase back behind me, so I got all my books lined up. So now I feel more comfortable. So I'm going to bring up your screen here, and I think we're all interested to learn about Mazda. And so now we see your screen, and we also see a video of you in the corner.
Mhm.
And before we start, I just want to, what I'm going to do just for a moment is I just want to look at the share price of Mazda, which will be covered up when I put your face over there. So Mazda's share price looks like it's come down from what was the highest? What was it? 1,925.
Yeah. It was around that amount. Yeah,
And then now it's at about 1,000.
144.
Okay, great. So, wow, almost cut in half, right?
Yes, yes.
That's fascinating. So, um, all right, well, I'm going to leave this to you to take it away. And so, as soon as I tell you so, when I leave this chat, then I'm going to be watching from the background, and I'll have a lot of questions, and I'm sure the audience will have questions. Remember, for the listeners and the viewers out there, if you got questions, just type them in the chat. All right, are you ready?
Yes, I am.
Okay, I'm leaving now, and then you just take over.
Okay. Hello, everyone. My name is George Fridelidzem, and today I would like to present my valuation report on Mazda Motor Corporation. I initiate coverage on Mazda with a buy recommendation based on a target price of 1,326 Japanese yen, implying an upside of 16%. I derive my target price from a DDM-based valuation using a cost of equity of almost 12% and a terminal growth rate of 2%. The highlights for this report are as follows. Large products as a growth catalyst given the rising foreign demand, electrification as a costly measure required to remain competitive and increase sales, and restructuring the supply chain, which may minimize costs and improve asset efficiency. There are also some risks that should be considered, such as failure to establish a stable supply chain, severe competition in the EV segment, present uncertainty in consumer demand for EVs, and high dependency on North America. To provide some background, Mazda Motor Corporation is a Japanese automaker that derives its revenue from the sales of passenger and commercial vehicles. In 2023, the company became the 6th and 12th car brand by sales in Japan and the US, respectively. Mazda CX-5 became the best-selling model in the firm's history, with around 33% of sales in 2023. Mazda holds around 3% of the global car market as of 2024, a tiny amount to be honest, by selling over 1 million cars. Mazda plans to launch Mazda ES6, the company's first global new energy vehicle, in 2024. Now, I suggest we have a look at three stories which will justify why there is a smooth transition towards prospective electric future. The first one is large products as a growth catalyst given the rising foreign demand. Mazda's large products are high-end large SUV models. In 2024, the company achieved a record high net sales and net income of almost 5 trillion Japanese yen and 208 billion Japanese yen, respectively. The growth was driven by increased sales in North America, higher plant utilization rates, and yen depreciation. Moreover, shift towards more affluent customers result in expansion of a customer base and growth of net profit margin. Also, Fed's cut rate may boost car sales in the upcoming year. That is why I predict Mazda to increase its car sales by almost 18% and gross profit by 16%. The second thing is electrification is a costly measure required to remain competitive and increase sales. Mazda decided to divide its complete vehicle electrification strategy into three phases. The major goal behind the electrification is the achievement of 25 to 40% EV sales by 2030 and carbon neutrality by 2035. Given the good growth rate for the EV market and the demand for decarbonization, safety, and sustainable mobility, the enhancement of Mazda's safety technology, co-pilot driver assistant, and fuel efficiency are likely to increase sales and attract eco-conscious people. That is why it is also important for a company to invest substantial amounts of money into those projects. That is why Mazda plans to invest almost 1.5 trillion Japanese yen through 2030 in R&D and capital investment. Finally, during the first phase of the electrification, Mazda was focused on cost reduction and enhancement of supply chain. The introduction of new standard containers with an improved filling rate of 90% resulted in reduced number of containers and truck services required. Also, starting from 2026, Mazda plans to purchase electronics and software from Toyota, which may result in substantial cost savings from the total investment costs compared to going solo. The company has already sorted out its supplier, its lithium-ion battery supplier, and is also expanding the use of general-purpose materials and semiconductors. Hence, I forecast an increase in the asset turnover ratio and in gross profit. Now let's have a look at the quarterly data of Mazda. So in the first quarter of 2025, Mazda experienced a notable revenue increase of almost 11% year over year. The company saw a 90% year-over-year increase in gross profit, a 68% increase in EBIT, and a 34% increase in net income. That is massive. Mazda reported a recurring EPS of almost 56 yen, which was plus 89% year over year. As for the latest news, Mazda announced plans to launch two new large products, Mazda CX-70 and Mazda CX-80, in the upcoming third quarter of 2025, which may result in a positive impact on revenues. Secondly, Mazda plans to partner with Subaru and Toyota to develop engines tailored to electrification. Finally, mass production of Mazda E6 EV is going to start in September with launch in the Chinese market in October. This is a good thing for company because it will allow it to assess the customer demand for EVs. As for the constraints of growth, well, they are neutral, with the main constraint associated with operations. The supply chain risk is relatively high due to fluctuating raw material prices and logistics issues in Suez and Panama canals. Also, Mazda is highly dependent on the North American market in terms of production and sales. Also, the broader adoption of electrification may result in a shortage of EV parts. Capital constraint is not considered is considered neutral because the company is slowly decreasing debt to equity ratio, and also achieved a tremendous growth of free cash flow to almost 240 billion Japanese yen in 2024, driven by introduction of a large product. This also results in a better financial stability and liquidity of the company. Market is very competitive, but still the company is quite stable and already has its customer base, so it shouldn't be a big problem. People is a minor problem because Mazda has one of the highest employee retention rates in the industry and is heavily investing in the development of its employees. Now let's have a look at the revenue breakdown for the company. Overall, the main revenue sources of Mazda are sales of passenger and commercial vehicles. The projected revenue increase in 2025 is associated with the launch of the three new models and contribution of large products. The customer base is mainly in North America, followed by Japan and Europe with 20% and 18% each. Throughout the last 3 years, there was a considerable growth in revenue and net margin, powered by recovery from COVID, the start of two-shift operations at Alabama plant, yen depreciation, and the introduction of new submodels. This allowed the company to build a strong foundation for the promising electrification. Also, Mazda CX-5 became the best-selling vehicle in the firm's history. Finally, I forecast the net profit margin to be around 3% during the next 3 years. Overall, Mazda appears highly attractive relative to 2,210 non-financial companies in Japan, considering fundamentals and valuation. However, momentum and risk are below the average level. Fundamentals are mainly driven by outstanding performance of asset turnover and return on assets. Valuation is ranked number one in Japan and is highly attractive since the company trades on low PE and PB ratio relative, to other companies in the market. Momentum is moderately attractive as the company didn't deliver any convincing results yet. Well, the risk is very high because of high beta, higher than average beta. Now let's have a look at the five-porter analysis. And here we can see that the main problem for Mazda is the bargaining power of competitors and customers. As for the competitors, Mazda is operating in the automotive sector, which is highly competitive, and most of Mazda competitors are much larger in size, and some of them operate in the same price segment as Mazda, which makes it difficult for Mazda to gain market share. The industry experiences moderate growth, mainly powered by the EV market growth at CAGR 2024-2029 of almost 7%. Also, the EV market growth led to a high demand for batteries and chips. And as was mentioned by company CEO in one of his recent interviews, there can be a difficulty with timely procurement of EV-related parts because of global shortage of those components. Bargaining power against of suppliers is relatively low because even though there is a shortage of those components, which is actually a big issue for the company, there are still some ways for the company to navigate through this obstacle, since the switching cost from one supplier's product to another one is not perceived as difficult. Also, Mazda has expanded the use of general purpose materials and semiconductors to minimize the impact of changes in the external environment. As for the bargaining power of customers, well, the automotive industry is highly competitive, as I already told you, and especially in the fast-growing EV and hybrid segments. Also, as for the pressure, that customers can put on company is relatively low because most of the issues are associated with logistics, shortage of trucks, and geopolitical risks, not with the pricing strategy of the company. Also, another problem is customers' high price sensitivity due to continuous inflation, and this is very noticeable in the North American market. Threat of new entrants is pretty low because it is quite difficult to enter the automotive industry due to substantial R&D expenditures, brand creation, and competitive advantage. As for the threat of substitutes, switching costs can be considered low because there is a high competition and minimal effort-based costs of changing brands. Also, companies like Tesla and BYD, which used vertical integration, show that it's possible to quickly gather market share in the EV market, which is a segment though. It's not a market, so the threat of substitutes can be considered high here. Now let's have a look at leadership and ownership. Chairman of the company is Kiyotaka Shibuda, and president and CEO of the company is Masahiro Moro. The board consists of 14 directors, out of which 43% are independent. This is higher than the national level and global level on average. Profitable growth has improved from 9 to 4 and fell to 5 in 2025. The rank stayed there in the past 12 months. Profitability was fluctuating between 5 and 4 and fell to 5 in the past 12 months. Growth dropped to 4 from 2 recently. Asset efficiency has ranked above average and improved recently. Conversely, expense control was poor and remained below average. Revenue growth has ranked in the top 20% since 2024, and it proved to be the world-class performance. It's shown a world-class performance and recently comprised the main driver of the overall profitable growth. Expense direction reached a peak in 2023 and then got worse in 2024, and in the past 12 months, it's just improved slightly. Average ROE, as we can see, also EPS growth shows outstanding performance despite a recent growth. Asset utilization is stable, nearly top. Net margin is also showing some signs of improvement, but is still below the benchmark. Sales growth experienced significant boost to top 20%. Net margin change, it's highly volatile. Let's talk about ESG score right now, which is very high for the company. The environmental aspect of the company is pretty good, despite for the fact that in 2018 there was environmental scrutiny due to improper vehicles emissions testing practices testing practices. However, after that there were no similar accidents recorded. On the other side, GHG emissions from 2019 to 2023 were decreased by 18%, since the company is focusing on lowering its emissions. As for the social aspect of the company, it shows 100%, which is impressive, which is really impressive. Most of the Mazda plants have ISO 45001 certification, which stands for safety and health management system. Also, the company promotes highly transparent and fair transactions and also has a policy for prohibiting bribery. Finally, the company has quality management system and received international operating standards and is certified by international operating standards. Governance, 43% of directors are independent, as I already said, and there are no insider dealings or accounting controversies found recently. Now let's have a look at the valuation of the company and its financial statements. The first one is profit and loss statement. Here we can see that there is a positive trend in the revenue growth and gross profit, as well as EBIT. However, net profit is predicted to decrease in 2025 and recover in the upcoming years. Balance sheet. Total current assets are predicted to grow mainly due to growth in cash and short-term investments and inventories. Total assets are also expected to increase due to net fixed assets. As for the liabilities, total current liabilities will increase mainly due to accounts payable and other current liabilities. Long-term debt is predicted to increase slightly in the next 5 years. Net income, as I already said, is going to decrease in 2025 as per the company's forecast, but will most probably increase in the next 5 years. Depreciation follows the same trend as the net income. CapEx, same thing as depreciation. Ending cash, however, has a positive trend. Ratios, current ratio for Mazda will remain constant at 1.4, and EBIT margin will remain around 4 or 5%. Most importantly, net profit margin will be around 3% in the next 3 years. Maybe. EBIT and NOPAT could increase in the next 5 years, as well as capital expenditures. Now it's time for relative valuation. So on the forward 2026 PB to ROE multiple, Mazda is traded at a significant discount comparing to Japan, Asia except Japan, and world. Also, Mazda ROE is lower than that of Japan, Asia, excluding Japan, and world. As a result, company is traded at a significant discount comparing on the PB multiple. On the forward 2026 PE multiple, Mazda looks cheap compared to the consumer's discretionary sector in Japan. The disparity between Mazda, Asia excluding Japan, and the world further highlights the same with a bigger difference. Overall, Mazda is traded as on a discount based on a PB multiple. On a PE multiple, Mazda calculation I assume a risk-free rate of 0.5% and a market equity risk premium for Japanese market of 9%. Hence, cost of equity is around 12%. Mazda has been a high beta stock, and so I assume a beta of 1.3, which is lower than the previous averages. I assume moderate terminal growth of 2% and a dividend discount model to value Mazda. In my base case scenario, I anticipate sales growth of 15% until 2029, leading to a value of 1,326 per share based on the DDM methodology. Here's the sensitivity analysis. Now it's time to consider main risks that the company may face. The major one is the difficulty in creating stable supply chain. Issues with logistics, including vessel and truck shortages and longer transportation periods, could disrupt the supply chain and increase operational costs. Moreover, the search for battery suppliers and transition to firms less dependent on Mazda's production volume may complicate supply chain management. This may result in productivity gaps. Also, there is a severe competition in the EV segment, which may result in Mazda unlikely being a leader in the sector. Also, there is a present uncertainty in consumer demand for EVs, as was highlighted by Masahiro Moro in one of his recent interviews. Finally, there is a high dependency on North America in terms of revenue and production, and this may makes company susceptible to any substantial decline or slowing in its operations. So here's the end of my report, and I hope I convinced you that it's really time to acknowledge the hard work that Mazda has done in the past years.
Excellent. Well, I got a lot of questions there. Let's go to the ratio page first.
Sure.
Okay, we can go to the next. Oh, yeah, that page right there. Sorry. So if I looked at debt to equity or net debt to equity, it's very low.
Yes.
Company doesn't have a lot of debt. And the interest cost on its debt is about, let's say, really low. Let's say at the bottom of this, we can see effective interest rate of 1%. You're expecting, let's say, 2 or 3%, which is fine. And it's increasing, in the recent quarters. So now go back to your summary of your free cash flow valuation, DDM valuation, and all that.
Mm-hmm. Cash flow statement, right?
Yeah, no, keep going down till you get to, keep going down. Next one. Next one. Yeah, this one. So I was looking at your debt as a percent of total capital, and it's quite high at 43.3. Is there something that I'm missing here? Like, are you expecting that the company's going to borrow more money, or what where does that come from?
Sure. Actually, currently the company's debt as a percentage of total capital is around 45%. So I expected a slight decrease in the discrete period, so that the debt percentage will be around 44%, and in the in the fade period, I estimated a decrease to 40, almost 40, 43%.
Okay, so
As a,
here I am as your teacher, and I got a question for you.
sure.
Why is there such a difference between the debt as a percent of total capital, which is very high at 43.3, and the ratios of debt to equity, which seem like there's almost no debt?
Mm,
What's the difference there?
mm,
I know exactly what's causing this, and it's causing your weighted average cost of capital to be very low, which is
mhm.
it's not a mistake, but there's something that's happening there. Any idea?
Mm, mm. That's an interesting question.
Well,
So,
I can give you a hint. It has to
okay.
do with the equity market value as a percent of total capital. Is equity market value high or low right now?
Um, I think it's quite high. It's more
No,
than
no. Your
no.
is your think about your PE, think about your valuation,
Oh,
price to book.
yeah, understand. The multiples for the company are currently low because the company is at the growth phase, and that is why. And also there is an undervaluation happening on the market. That is why even though the PE and PB multiple are lower relative to the industry average, the company is still the company is undervalued. And
Yeah, so what's happening is it's causing the equity value, right? The
yeah.
market value of equity to be more than half of the book value of equity. And therefore it's pumping up the debt as a percent of total capital. So the
Hmm.
cost of capital in this calculation ends up being pretty low, and it's realistically calculated, um, but it'll change over time if the stock price starts to go up. Uh,
Sure.
so let's talk briefly about the dividend discount value versus the free cash flow value. Tell me some more about what you're doing with that.
Yeah, sure. So I chose to go with this dividend discount model because the company proved to have a stable dividend payout ratio over the past years, except for COVID, which was which was the exceptional year because the company didn't pay any dividends at all, and it was in 2021, and um, I believe that based on the revenue forecast and previous revenue data and the dividend payout ratio, it can be seen that the dividend payout ratio directly correlates with the revenue, and it's a good indicator of whether the company is going to grow or not, or what is
And
going to happen
what's your
with the company.
assumption on dividend payout ratio for the future?
Yeah, so I expect a gradual increase in the dividend discount model, in the dividend payout ratio, because the company is going to generate more revenue as per my forecast, and is likely to increase.
What is the dividend payout ratio that you're assuming roughly?
Uh, I'm assuming around more than 20%, and at the terminal period, the phase period, it should be
Mm,
around 25%. Since
okay,
the
so
company is not very generous when it comes to giving dividends, but it's almost certain that the company is increasing dividends as
okay,
the
so
revenue
let
increases.
me ask you the next question, which is why has the share price fallen so much and it's become so cheap? If I look at it compared to, let's say, I was just comparing it. Of course, if you compare it to something like Tesla, it's out of control. But
Yeah.
let's look at price to book because that's a relatively stable measure. The price to book of Tesla is crazy. It's at 12 times, but the price to book of Toyota is at 1 time. So you can buy Toyota basically for the value of its assets, and it's very profitable and the like. But the price to book for Mazda is like 0.4. So it's like you're buying this company at a 60, you're buying the assets of this business at a 60% discount, and you're getting all the future growth for free. Why is it so cheap? I don't expect
Yes.
it to be like, Tesla, and I don't expect it to be like 2 times price to book. But if Toyota is 1 times price to book, should Mazda be at 0.6, 0.7, 0.8? What are your thoughts?
Well, one of the main differences between Mazda and its competitors is that Mazda is operating slightly above its break even output, and I think that is something to do with the low PB ratio, because the company has lower assets comparing to its competitors like Toyota or even Tesla, and uh, I think that is what causes this divergence. And also, as for the recent drop in the Mazda share price, the drop of 35% around 35% in the last 6 months was noticed, and this was because of the forecasted decrease in net profit for the company, since the company revised its assumption on yen on the exchange rates, and is expecting higher costs of raw materials, and that is why I think, yeah, those all factors contribute to the share price being down that much.
And let's look at the world class benchmarking scorecard for a moment.
Yeah.
Yep, keep
Oh.
going. Look at the triangle.
Oh. Yeah. 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 Nice. Yeah.
This is an interesting one because if you look at profitability, it was a 9, a 7, a 4, and a 5. So it's, after COVID, it was hit hard in 2021, but it's been having a steady recovery. And that recovery is happening in asset efficiency. You can see asset efficiency was 4 or 5 ranked relative to 870 large consumer discretionary companies. But then it got to 3 as revenue started cranking up. And all this company has to do is improve its expense control. Right now, if I look at the net profit of, um, let's say I look at the net profit margin of Mazda is about 4.3, Toyota's at about 11, right? At about 10. So if it can move its margin from 4.3 to 5, 6, 7, 8, it's going to really drive profitability. What are the chances that they can improve from here, or are they stuck in a situation that they can't improve very much from where they're at?
That's a good question. I think that the company is definitely going to put much effort in cost minimization as they were doing in the first stage of their electrification strategy, and it can be seen on the expense control in this world-class benchmarking that in the last 3 years there was a notable improvement in expense control because of improvement logistics and enhanced usage of asset utilizations. But I think that the company it will be very difficult for company to minimize costs even more. I think there will be a positive trend in this area, but I don't think that the company
Okay.
will massively decrease the costs because
Okay.
it experiences it's very dependent on the customer's demand, and it's not that flexible when it comes to strategy creation, and it needs to adapt its strategy based on the demand and market environment. It's not
So,
like Toyota or Tesla. It's very, very smaller company.
so Nor Osama says, why did you use DDM, not DCF? Can you just repeat that?
The DDM, not FCFF, or
Yes. Yes. You use dividend discount model rather than the free cash flow of the firm.
yes, yeah. So one of the main reasons why I used DDM except for FCFF was because of the stable dividend payout ratio, which proved to be um, relevant, highly correlated with the revenues of the company. As for the FCFF, also the company is currently experiencing is in the growth stage, in the growth phase, and that is why the company's FCFF and FCFE are extremely high, and there is an upside of more than 100% there. Also, I think that the company is very volatile, and that has something that may contribute to the such an upside of FCFF, and also the capital structure is likely to remain stable in the upcoming years. So I don't think that FCFF is quite appropriate here.
Okay. And Zishan asks the question, given recent decline in demand for EVs worldwide, do you think the target of 25 to 40% EV sales by 2030 is an achievable target?
I was actually also thinking the same because when I was analyzing the company, it seemed to me that such a high rate actually in like 20 even 25%, at least like one fourth of the whole sales. It's pretty high, I guess, for the company like Mazda, and I think that given the words of the Mazda CEO about the uncertainty of demand for EV vehicles, I think that the actual EV sales ratio will be more than 10%, I think, but I think less than 20%.
Okay. Can you go to the balance sheet? Let's look at the assets. Um, were you on that call that I did with Japan? I don't know if you were on that. I did a
Unfortunately, I missed this
Okay,
one.
you missed that. So one of the questions that the one of the guys that's valuing companies in Japan was asking was about what is about the cash levels, and I see that cash is about 923 and total assets are 3792, which would mean cash is about 24% of total assets. Do you have any thoughts about, you know, it seems like a pretty high level of cash. We know that the average cash level is 11% globally, not for car companies, but just globally. I'm just curious what your thoughts are about the cash levels of Mazda and what we should take from that.
Yeah, so I forecasted I created such a forecast for the company's cash and short-term investments, mainly because the company is a very it's a very small company, and it's very dependent on the demand, and through high cash and short-term investments, the company aims to create some sort of a instrument through which it will be possible for the company to adapt to the changes in the environment. Because unlike Toyota or Mercedes or Tesla, the company doesn't create substantial revenues, and that is why I think that cash and short-term investments should be high to give the company some sort of flexibility. Because otherwise, the company will experience much higher risks if their strategy does
Hmm.
not prove to be effective in the short term and in long term.
Okay. Hold on one second. So how does it feel to graduate from the Valuation Master Class?
Oh, it feels amazing, to be honest. I was waiting for it for 3 months. I wasn't waiting for the end. I was waiting for the day to I will look back and see the progress that I've made during these 3 months that I was doing this internship, and it was a great experience, and I want to thank everyone who was with me during this journey and who supported me and who helped me grow and who motivated me.
Mm. And let's talk about, how did you grow? What was your transformation between the day you came in and today?
So basically, I think that the main transformation that happened to me was I definitely gained new knowledge from this internship because before this I was I was doing pretty well. I was good at analyzing financial statements, but this program, this internship, gave me the opportunity to deepen my knowledge and create those. Logical links between the components of those financial statements, and it helped me to better understand how the markets move in general, and what items have effect on what items, and how to make a good report, and how to ensure that your forecast is reasonable and it's not like 300% upside.
And what is it that you think, when you think about your future now, about what you can do, what you want to do, how does that compare to the way you were looking at your future before you entered this internship in the Valuation Masterclass?
Mm, I think previously I didn't consider myself as an analyst. I was good, and I think that my research skills also improved during this internship, and by providing feedbacks to other students during the internship, and by analyzing the markets, I just noticed that during my assessment of other students' valuations, I was making evidence-based judgments, which were proved by recent market trends and were reasonable with the forecasts made by some large financial institutions. And this is something I never really paid attention to previously, because I was thinking about analyzing the company and industry. But now I think I'm better at analyzing the whole environment, and making those logical links between items and between different things. Yeah.
All right. Well, let me personally congratulate you, and I'm going to take you out of this and close it down. Just hang on, and I'll be right back. Hold on. Well, that was pretty amazing. Mazda looks dirt cheap. Of course, Japanese car companies are they're struggling with the yen. They're struggling with very high levels of cash that they're not necessarily deploying efficiently. But still, it's trading at a 0.4 times price to book, which means you're getting a 60% discount when you buy. You're buying all the assets of Mazda at 60% discount, plus you're getting all the future growth for free. I would say that Mazda is worth looking at for a long-term portfolio. If you want to build a competitive advantage in company valuation, just like George has, which we've just seen, make sure you join